What's up, guys? Today's video is about risk management and why you need to be a good risk manager to be a good trader. The reason I'm doing this video today is because, as you can see down here, I took a pretty big loss compared to what my wins are. The reason for that was not because of, well, it was partially because of how I took the trade, but more because of my laptop. I got a bad entry just because my fill was way later than I wanted to get in here and got in there. That's not any excuse, but that's kind of just what happened. And, if you take a loss for a reason that you can identify, you can fix it. So I knew my laptop was on battery saving mode. I usually trade on extreme performance. So now on in the future, every day, I'm going to set an alarm 10 minutes before open, make sure I'm at extreme performance. Because if I'm here, I'm just going to get a late fill, and that's going to cause me potentially to spiral down the wrong end. So yeah, I wanted to get in here. That would have been a nice scalp for this 240 break. Right here, I saw a red to green at a trend line break. Boom, quick scalp. I wanted to get in contracts where I believe like 330 or 340, and then I ended up filling close to 10 seconds later at 370. And when you're scalping, every second counts. But yeah, this video is more about risk management. But just so you see, this 510 loss that could have been avoided, that could have been break even or green. I would have been up close to 10%, but since it filled me up here, I was break even up here. But that was the move I was looking for, to be honest. I was looking to sell at this 240 break after that. But that's beside the point. Today's about risk management. So, tip number 1, winners have to be bigger or equal to losers. So as you can see, this 510, that's not my average win. So I broke probably every rule here except for this one. Yeah. So yeah, winners have to be bigger or equal to losers. You don't want one loser to take away from all your wins of the week or all your wins of the month, which I see a lot. Like, people would take one bad trade and then it'll cause them to be red for the month when they were green every other day. So you need to be able to make back your losses. You don't want one trade to set you back. That's pretty much what I just said. If you know that your average win is $100 to $200, you don't want your loss to be pretty much over $100, because if you take another trade that sets up properly, it's not just a revenge trade, it's an actual planned out good setup trade, that you can make 100 to 200 on that. So if you lose, let's say 500, and your winners are 1 to 200, and that's not good risk management. So by keeping a tight stop, if your stock sets back up, you could always try the setup again if it meets your standards for entry. Yeah, you just want to keep a tight stop. Same thing. Winners have to be bigger or equal to losers. If you have a wide stop and tight wins, that's not good risk management. Stay away from high risk, low reward trades. So for example, let's say you're chasing something, you're looking for a 10-20 cent scalp, but you're risking $1. That's not something you really want to trade. It's not worth your money, even if it's a 99% win rate. I'm not going to take something like that just because your risk to reward is way off. So, and you want high win rate strategies. You want to find a strategy that works for you, that has a high win rate, and that consistently, if you keep sticking to a good tight stop loss and let your winners go to where you want to take profits, and it's a high win rate, then over time you're going to be that consistently profitable trader that you're trying to be. So tip number 2, your daily stop loss shouldn't be significant. So let's say you make $200 a day. Monday through Thursday you're all green, but then Friday you take a $3,000 loss. That tells me that your daily stop loss, like, you didn't stick to one, you didn't have one plan, you just kept taking trades, or you let one trade totally bleed out, like 60% loss or something like that. So you want to have a daily max stop loss that everyone's different on their win rates and their how many green days they have compared to red, but generally you want it to be less than your green day. So if your green day is 200, you want your red day to be 100 or 200 max, ideally, maybe a tiny bit more if you have a lot of green days compared to red days, but still, in my opinion, that's pushing it. So respect your max daily loss. If you're not trading well one day, just call it early and come back tomorrow. So if you see yourself, emotionally trading, holding longer than you're supposed to, taking bad entries, and you realize that early on, just close your system, call it a day, go do whatever you want to do, and just come back tomorrow with a clear mind, so you're not forcing anything, you're not taking bad trades when you shouldn't be. So today, I meant to get in here, I filled up here, stock came down here. This all happened so quick. I didn't see any of these ticks. Like, since my computer is running so slow, I barely saw this 240 break. I filled up here. This wick happened so quick, so I'm like, all right, whatever. My stop loss is going to be down here. That was like a 30% stop. That's something I usually don't do. Normally, I'd be stopping out max right here, where this candle went red to green. This, I just had this stop because, it's 2 candles lows. This happened so quick, I couldn't even react to that. So, yeah. Everything about this was bad. And I knew once I got filled up here, I was already starting to get emotional. It might be hard for me to find, but I literally have a picture of me, because I was recording. I'm not going to show the recording just because there's really not much you can learn from it. But yeah, here's my face when I saw how I got filled. So you see where the candle is, where I got filled. 240 already broke. I was looking for that break. This is where I tried to fill. So almost $1 move before I got filled. So that's something for you guys. But I learned already. I already made a solution to that, so it's not going to happen again. I set an alarm. I'm going to be on extreme performance, and now I fixed a cause for one of my bigger losses, which is what you guys want to do. If you see you have a big loss, you have to fix it immediately, find a solution to it, and stick to it. There was the day I did a red trade recap, I showed you guys something that I could have done in both of those trades, and literally the next day I kept a tight stop doing that exact thing. But I'm totally getting off track. All right. You can't let one day ruin your month. I talked about that. Even if you have a red day or two in a week, you should still be green or break even by the end of the week. Our goal as traders is consistency. This is not a race to become a millionaire. Once you try, to do this, try to be rich quick, you're going to be going in way too heavy. This goes with the next thing. You're going to be way too heavy. You're not managing your risk right. Sure, you can be consistent, but if you keep, full porting every trade you take, it's just going to take one trade where you're in way too heavy. You're going to start to get emotional when it pulls back on you. You're not going to stop out. And then that's going to be a big red day to bring your month down. You don't want one day to affect your week, or especially affect your month. The goal is consistency. Everyone's going to take red trades. Don't let that one red trade affect you too much. Another tip, proper position sizing. What the heck did I just say? Proper position sizing. Know what your risk is going into the trade. So some trades, you might have to have a wider stop just by the setup of the trade. And then some trades, your stop could be super tight. So if going into the trade, you're going to have a wider stop, you can't go in too heavy, be on your lower end of sizing. So let's say you have 1 to 2,000 position sizing, and that this trade, it's still a good setup, has a good probability of success. Still be in closer to your lower end of sizing, just because that you're risking more than your general trade. If things go against you, you have to be comfortable with taking the loss. So no one has 100% success rate. Even 80% is really good. But if you let those 20%, really bring you down and you have an 80% success rate, there's really no point because you're not managing your risk right. If you manage your risk properly in every single trade, then no one trade is going to take you down. And those 80% can really help grow your account in the long run. Like really those 20% should be absolutely nothing. Those are just blips in the radar. Know what days to size up and what days to size down. So some examples I gave: FOMC, earnings days, any market making news. And another thing I would add is Fridays. Fridays you always want to size down. It's same day expiration on contracts, so contracts are going to move twice as quick. Even Thursdays, I'd recommend sizing down, just because contracts move super quick, so it's going to be hard to keep that same tight stop loss. Like something that might be a 5% stop on a Monday or a Tuesday can be closer to 10 or maybe even over 10% on a Friday, just because they're the 0 DTE options are really nothing to play with. So you want to be in light. You can still make the same amount of money with less money. So going in heavier is just hoping to be rich quick, and you're taking a lot of risk by doing that, because you want to be comfortable stopping out on any trade that you get in. You don't want to be so attached to a position where you're like, oh no, it's gonna happen, let me not stop out. And also know what stock you're trading. So this is very important for risk management. Not every stock moves the same. So for example, SPY, even though I do have some really high returns trading SPY, like those 40-50% returns, those aren't in every if you stop out on SPY, your stop loss is most likely 10% or higher. It's hard to keep a stop tighter than that, like a realistic stop tighter than that, just because there's 0 DTE with low IV. So any move is going to move SPY contracts a lot. So for SPY, I'm honestly even under my average range for individual stocks. So let's say I'm 1 to 2K. SPY, I'm probably 700-ish range, just because they move so quick. And let's say a green trade on SPY, I know I've taken, like I was just reviewing a trade, I made I think 30%. So 700 times 30 is $200. So that's good. Like that's generally what I try to look for on my green trades, about $200 ish. But yeah, stop loss, like let's say 700 times a 10% stop loss, that's $70. That's fine. That's not going to affect me. I'm not going to care if I stop out with a $70 stop loss. Like that's not anything I can't make in a green trade. Something like this is way too high. There was almost everything in the book went wrong with this. I was emotional after I saw this, and I let my stop way too big. I should have stopped out right here, literally next minute or even a couple seconds later. But I just held it. I let it do its thing. I saw it was rejecting this trend line. I just had hope that it was going to go up, and that's exactly what you shouldn't do. So I hope you guys learn from my mistake. This is the point of this YouTube. So another thing with knowing what stock you're trading, some stocks have really wide spreads on contracts. So if you do end up stopping out, the stop loss is going to be a lot wider. So I'm going to show you, just as an example. I know this stock is going to have a wide spread. Damn, it doesn't. Okay, yeah, look. Let's say you're playing these 207.50 calls. That's a 10-cent spread on a $1 contract. So that's already, you're filling down 10%. So if you're stopping out even past that, your stop loss is going to be close to 15-20%. So you don't want to be in full size when you know off the bat you're already down 10%. Yeah, these even have a lot of volume. But yeah, something like that 10 cent spread versus, I'll go to Tesla, which I know they have good spreads. Look, 1 cent spread. You're gonna fill break even every single time you play Tesla. BA, Moderna, just these random stocks. Look at this, a crazy spread. You're gonna fill down so much. I honestly wouldn't even play this seeing a spread like that. But if you really have to, this is the best setup you've ever seen in your life. If you see a spread like that, you have to be in super light, just because if you do stop out, you're gonna have way wider of a stop. So let's say you market buy and then you market sell, you're gonna be buying at 125, selling if you stop out probably at 90 cents. So that's a crazy 90, oops, that would be almost a 30% stop loss if you stopped out at 90 cents. So that's just something you have to know. If you do choose to play those widespread contracts, which 99% of the time I'll just skip the play entirely, you have to be in super light, just because those stop losses are going to be a lot wider. And usually these, if you do play these stocks and it does go your way, you're going to catch a big percentage, so you can still make a good amount of money with a smaller position size. But okay, this is the main takeaway of this whole thing. Don't risk more than you can make. If you know you're making 200 on a green trade, keep your stops tight at $100. You can always make that back. It's not going to make you emotional. So when you're in a trade, keep that in mind. When you're looking at how many contracts to buy, if you're buying 50 of these contracts, it's going to be hard to keep a $100 stop loss, a realistic $100 stop loss. But if you buy 3, 4, 5 of these contracts, yeah, you can. But yeah, this is pretty much just risk management as in day trading, and why it is important to keep good risk management. Work on this all the time. Keep journaling your losers, how to keep stops tight, how to get more out of your winners. For me, getting more out of my winners is scaling out. It's what works best for me. Sure, I am leaving some money on the table sometimes by selling early, but it's also what helps me hold more of my position for longer. Because in the beginning, I would be selling green, 3-5%, but taking those 10% stop losses. So that's not really good risk management, even if I have a really high win rate, because 2 green trades could be taken over by 1 red trade, just because of that's how numbers work. But yeah, I'm just gonna cut it there. Yeah, peace, guys.